Welcome back. Well, the big news today was not on the economic calendar, but rather in the bond market, where the 10-year bond hit 5% for the first time in a long time, actually since 2007. Closing at the day at 486, but we did breach a little bit above the 5% level earlier today. And we can see we still have very much an inverted bond market where the short term yields 1, 2, 3, all the way to 6 month, even the 1 year are in excess of 540, 550, even almost 560. The 10-year is at a 486, but we're going to discuss the ramifications of why this is so significant. This is the change, the 1 month change in the bond yields. Now, these figures represent the percentage change of the yields. So we know the 10-year bond yield is up 7% in the past month, same as the 20-year and 30-year as well. The short-term bonds really have not moved at all. And if you remember earlier on, as the inverted bond market came to be, it was the short-term yields that were moving, but now the short-term yields are not moving. It's the longer-term yields that are trying to catch up in anticipation of maybe higher interest rates for a longer period of time. Last week, the Federal Reserve speakers, including Jerome Powell, met and spoke specifically about perhaps delaying longer interest rates. And that's, I think, why we're seeing the longer term maturity start to move up in yield. Here we see this is since June of this year, the change in the bond yields. Now, the big move has been the long term. The dotted red line, that's the 10-year. The white line, that's the 30-year. The brown line, that's the 7-year. So all these long-term maturities have gone up from 3.7. Well, today the 10-year is at 5%. So we've seen a move up on the longer term spectrum. The short-term bonds at the very top, we have the 6 month, we have the 3-year, the 3 month as well. The solid blue line over here is a 1 month. These have not moved. All the movement in the bond market are the longer term yields moving up. Again, perhaps in anticipation that we're going to have higher interest rates for a longer period of time. Now, here, this goes back to 2006, well, 2001 through 9. But in particular, notice how the markets acted in 2006, 2007. Now, the black line is a 10-year bond, which again today hit 5%. Notice just about 5% right over here, 2006, 2007. The red line is the S&P 500. Now, we know eventually when the financial crisis of '07, '08, came to be, it was a stock market that really started to sell off before, I'm sorry, the 10-year bond, the black line, sold off before the stock market. The red line, the S&P 500, did not move immediately. It was the 10-year that moved down in anticipation of lower interest rates on the long-term basis. Well, this is where we stand right now. The white line is the S&P 500, and that's moving down. The 10-year is this orange or violet line, and it's only moving up. And this is one of the most important things, I think, the takeaway today, the divergence in behavior between the S&P 500 and specifically the longer term bonds like the 10-year. Typically, we see these two securities move in the same direction. The stock market tends to move in the same direction as yields because when the stocks go up, the bond market has to offer higher yields. Well, this goes back to 1992. Take a look at the 10-year and the 1-year. Now, specifically, we have a pattern that emerges over time. We have periods of economic strength and both yields move up. The red line is the 1-year and it crosses above the 10-year inverted bond market, and then the 1-year really comes down. That's 2001, 2002, and then the 10-year follows. We had a period of economic strength, 2005, 6, and part of 7. The 1-year rallies back up and crosses above the blue line, the 10-year, and then the 1-year leads the way lower. The short-term maturities are faster. They're more reactive. We had zero interest rates, and that's why the 1-year was so low for so long. It ran up and touched the 10-year in 2018, then back down. Now, right now, it looks like we're still really kind of early in the cycle, believe it or not. The 1 year has skyrocketed higher. It's still above the 10 year. So, point being, for those of us that are eventually anticipating a reversal, a stock market crash, perhaps a real economic recession, in the past, the signal has been that the 1 year crosses back below the 10. The 1 year, the red line, again in '07, '08, crosses back below the 10. Well, right now, the 1 year is not crossing below the 10, and the 10 continues to strengthen. So, on that account, we're still looking, if you were to use, past markets as a comparison, it looks like we're still 1999 or perhaps 2006, but much more extended at this place. Here's the red line's a 10-year bond, the black line's the S&P 500. And again, really interesting divergence. In the past, we see the 10-year go up along with stocks. The 10-year comes down with stocks. The 10-year cannot seem to stop going up, while the stock market really cannot find a strong buyer anywhere. Now it hasn't been huge moves to the downside in the stock market, but there certainly has been a very weak trend overall. And to just go back, take a look again where we are now in terms of the 10-year. The blue line's a 10-year. We're above 5% for the first time going back to 2007. This is a very significant level. Again, we don't yet have that signal of the 1 year crossing back below, but it is important to note these very significant tops that we've seen. And again, the real troubling point is that we have this divergence where the 10-year bond yield doesn't stop going up and the stock market really can't seem to find a strong bid out there. So we perhaps may expect a return to normalcy, or at least a regression to the mean, or at least the 10-year bond yield won't go up, or maybe the stock market will stop going down. And I think there's a lot of traders out there anticipating exactly that. How that takes form, it's anybody's guess. But I think it's important to make note of the divergence because it is pretty significant and probably pretty unusual as well. We hope this has been helpful. We look forward to seeing you back soon.